This is the CRE Weekly Digest by Lightbox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Melissa Lewis with our experts Manus, Clancy, and Dianne Crocker. This week, we've seen more market chaos. U.S. stocks plunged. By last Friday, in response to the war in Iran, oil prices had surged to about $80 a barrel. This week, they spiked as high as $119 a barrel. By midweek, the 10-year Treasury was hovering around 4.2% after a sharp bond sell-off that marked one of the worst weeks for Treasuries in months. On the inflation front, this week's CPI report came in slightly cooler than expected, offering a bit of relief after several months of sticky inflation data. And just last week, we dialed into private equity woes. So it feels like we're a little all over the place right now, Manus. What do you think?
I think it's been really a terrible week for not only the broader markets, but for CRE as well. And I think peeling this back will take some time. Let's try to retrace what we've seen over the last week. You've talked about some of this. When we started the war in Iran, or shortly before it started, oil was in the $60 a barrel range. It shot up to 80, then 90. Eventually, it was almost $120 a barrel. Stocks were selling off. Bond yields were rising. Never a good thing for CRE when you're seeing the yield on the 10-year just shooting up day after day. And then all of a sudden, we saw the president come out and say, hostilities are almost over, and the markets did a complete 180. Treasury yields fell. The U.S. equity markets surged, and it seemed like for a moment that we might be back to a period of normalcy. Oil prices dropped to about $80 a barrel after that announcement. And again, it seemed like it was full speed ahead for the markets. Now we fast forward to Thursday of this week, and the markets are again just all over the place. The president came out today and said, we will be staying in Iran as long as we need to. U.S. stocks are posting sizable losses today. The NASDAQ down about 2%. And the worst of it all is the 10-year Treasury this morning up to 4.25%. And that makes sense. Oil prices today up about 10%. We're back to about $90 a barrel. I think even higher now. And if you connect the dots, you're saying higher oil means higher utility bills. It also means higher production costs for anybody that manufactures anything. All those costs are passed along to buyers. So the impact of this on future CPI is sizable. So it only makes sense that the 10-year is surging right now. And we can only hope that this ends sooner rather than later, because this is incredibly unconstructive right now for the CRE markets and the equity markets.
Yeah, that's exactly right, Manus. I mean, when you step back and look at the big narrative this week, the focus has been on the war in Iran, and it's easy to see why investors are a little on edge, especially considering the whipsaw that you just described, where, the market reaction was pretty encouraging at first, and then by the time today's recording came around, it had reversed again to where it was closer to the end of last week. We're seeing oil prices spike, go down, and spike again. And we all as consumers feel that in real life pretty quickly. I mean, I just filled up my tank this morning, and here in Connecticut, I paid $4.19 a gallon. I'm not sure what it is where you are, Manus, but, the price spikes will certainly go into the next round of CPI and the implications that obviously come from that. I wanted to share something that I just read yesterday with you, Manus, and get your thoughts. It was a post by Ryan Severino at BGO. He's a great follow on LinkedIn for any listeners that don't already know him, and he's a friend of this podcast and a past guest. But he wrote a piece yesterday where he said that we're living in an almost economy. An almost economy was in quotes. And his point was, on paper, and this is separate from the war in Iran, but on paper, the economy looks pretty healthy. GDP is growing, unemployment is low, consumers keep spending, but that the underlying dynamics don't behave the way they normally do in an expansion, meaning things we've been talking about here. Job growth has been unusually weak. Employers aren't hiring as much as they were. Many of the cyclical signals that we usually see with strong recovery, they're just not there. And for us in commercial real estate, we typically see demand tracking employment growth. But if the economy keeps expanding and companies aren't adding workers, then the drivers in commercial real estate aren't accelerating the way they typically would. So maybe we can't have job growth and a growing economy and peacefulness on the global scale. Maybe we can't have strong consumer spending and positive soft data on sentiment. So that was his point, that it's like an almost economy, but not quite normal. So Manus, I was thinking last week, you used that Don Henley lyric, "The more I know, the less I understand." And as I was driving in this morning, I was trying to think of a lyric that pertains. And I just landed with hearing Mick Jagger singing, "You can't always get what you want," because the metrics are all over the place.
Well, I love Ryan's analysis here, and I always find him to be very forward-looking in his thinking. And again, here I think he's kind of nailed the current environment in what we're living through. But I'm going to challenge both of you, maybe give you some homework for the week. We use the term often here, Goldilocks, and we talked a couple weeks ago about the potential for a Goldilocks scenario for CRE. And that Goldilocks at the time went like this, that the problems in corporate loan, private equity space, which we'll get to in a minute, causes people to get very nervous about the US economy. It forces interest rates to come lower. So we see a 10-year that's maybe 375, not 410. And that creates a huge tailwind for CRE because CRE is considered immune to the lack of discipline in lending that took place in the PE corporate space. That was the Goldilocks. So the homework for this week, maybe our listeners can weigh into, what is the opposite of Goldilocks? Like, what was the term you would use for the worst case scenario? Is there a mythical character that we could assign to this? Because when we talk about the war in Iran, you now talk about the potential worst case scenario for CRE. And what does that anti-Goldilocks scenario look like? It is the war goes on for an extended period of time. We're dealing with $100 a barrel oil for months and months and months, that people are getting hit at the gas pump. They're getting hit warming or cooling their homes, and they're hit because everything goes up, because almost everything in this country is made in some way or fashion using some kind of petroleum product. That leads to a spike in CPI, a spike in PPI, and ultimately, not only does it lead to a U.S. recession, which is obviously detrimental to CRE, but it also leads to a perpetual period of time where higher oil prices lead to a 10-year Treasury of 4.5, and we linger there for 6 months or 8 months, right? We would be back to where we were 2 or 3 years ago, I think, in economic activity. That is the anti-Goldilocks scenario, and it is the reason why everybody in our market, aside from the humanity side of it, should be rooting for a quick resolution to the war in the Middle East.
Yeah, it's a good challenge, too, to think of something that's kind of the flip side of Goldilocks. Nothing comes to mind right off the top of my head, but I'll think about that. And the other thing that you didn't mention is, yes, to the spike in prices and the economic effects that could kind of ripple out from there, but also in an already weak labor market that also causes further weakness, and uncertainty isn't good for anybody in the market. Obviously, it would weaken hiring, it would weaken demand for commercial real estate. So you could easily see, to your point, that the worst case scenario involves a major tapping of the brakes for commercial real estate the longer that it goes on. So hopefully we don't get there. Next week, I'll come to the table with a few suggestions for the flip side of Goldilocks.
I just came up mentally with one. Maybe you'll like it, maybe you won't. And I'm eager to hear what you come up with over the next week. But I was just thinking, what character is always getting kind of rained on, kicked in the teeth, that type of thing among, children's characters. And I came up with Eeyore, right? The Eeyore economy, right? Where everything just goes wrong, right? From Winnie the Pooh, that, the rain cloud is always sitting right above Eeyore. And maybe that will be the phrase we end up coining, which is the opposite of the Goldilocks. But I do want to spend some time on a separate issue, which has also been dominating the headlines, and that is the problems in private equity corporate loans. We saw recently that, we think we talked about this last week, BlackRock had taken a position and written it down from par to zero. This was a lender in the UK that has now been accused of fraud. But there's this perception that there are cockroaches everywhere living in the portfolios of private equity lenders, and there is a powder keg of losses waiting to be ignited. And what we've seen over the last 10 days or so is that firms are gating redemptions. So firms like KKR and Ares, Blackstone, BlackRock, I'm not sure who has gated thus far and who hasn't, so I'm lumping them all in together. But they have said, we're going to put a lid on redemptions. We're not going to let you take your money back. We're going to say no to your request for return of capital. And there was a lot of anger about this week. People were investing in these thinking they were liquid assets, and now they're being told they can't get their money back. And I understand why people who invested in this are angry. You want your money back. But in our write-up this week, in our research that we posted on LinkedIn, we said that this was a positive for the market. And I want to get into that, into the weeds on that, why this is a positive. But before we do, I want to throw it to you, Dianne, and just get your hot take on all the headlines we're seeing with PE and corporate loans. Do you think that this is a big problem, or do you think it stays contained?
That is the question, right? The bear case obviously is that the losses kind of spread outward, that credit tightens, that commercial real estate gets caught in the crossfire. And then the flip side is that the anxiety keeps the Fed cautious, and potentially we end up with rates lower than most folks expect this year. And then commercial real estate maybe starts to look like the steady asset class. Didn't you once refer to commercial real estate as the grandmother at a toddler's birthday party? That commercial real estate looks steady compared to the volatility in equities, and that under that scenario, it could actually support refi activity and transaction momentum rather than derail it. I did want to mention, Manus, I'm not sure if you saw it, and apologies because I don't have the citation in front of me, but there was an op-ed piece in the Wall Street Journal about equities and the whole, typically there's a trend toward the steadier equities whenever there's unrest, but that it's playing out a bit differently here because with the headlines about the risks surrounding or potential risks surrounding AI stocks being overvalued, that folks had already started moving to the kind of stodgier, safer buys, and that because that had already happened when the war in Iran started, those didn't look as attractive because the migration had already begun. Did you see that?
I did see that, and I do think that that is really true. And we also have to take into consideration that typically these stodgier operators are making something, right? They're making cornflakes, they're making, some kind of widget that we need, tires or auto supply parts or something like that. And people race into those things for the steadiness of them during tumultuous times. But if that tumult is a function of higher oil prices, these guys are not necessarily winners. If it costs you more for fertilizer to grow your corn, to make your cornflakes, is it really a safe place to be in the short term?
Yeah. So again, let's hope this isn't prolonged for a lot of reasons.
And we'll close on this. The gating, which started with Blue Owl saying that they were going to limit the amount of money people could get redeemed, basically meant that all of these operators who have gated do not have to sell their assets, their loans, under duress and at fire sale prices. And I said in the research we put out this week that the broader market should thank their lucky stars for this. Yes, there's annoyance at people that are in these funds, But the rest of us, we should be thanking the heavens. And the reason for this is selling begets lower prices begets more selling, and you get into this doom cycle. And if we had a situation where KKR, Blackstone, Blue Owl, Ares did not gate, and everybody wanted their money back at once, and they were forced to sell illiquid loans at steadily declining prices, lower and lower and lower, eventually anybody who had a loan would have to start marking down the value of these loans, right? Even if they were a healthy operator, the fact that people were giving away assets essentially to meet redemptions would threaten the entire marketplace. We saw this in 2023 when Silicon Valley Bank was forced to sell CMBS holdings under duress. Values of those securities just collapsed until the Fed stepped in. We should be grateful that we don't need Fed intervention here, that these companies were able to gate and it prevented this doom loop, which I think would have been incredibly painful, if not the trigger for something bigger and badder happening.
And there's the Eeyore scenario right there, is that the house of cards starts to kind of implode. So hopefully any damage is contained, but it's certainly something to watch.
Dianne, last week's Lightbox Data Dive gave us one of 3 elements of the February CRE Activity Index. What do you have for the final number?
Well, Liz, so the last 20 minutes have been doom and gloom and a lot of talk about Eeyore. So we'll pivot here in a big way. We have the full reading this week of the February Lightbox CRE Activity Index. The index rose to 118.2. That was an uptick of 7% above January and 12% year over year. But the headline, Manus, is that it marks the highest reading in the index since May 2022. So before I get your response, I want listeners to know that behind the bounce that we saw in February, we have brokers listing properties at volumes that were 9% higher than an already strong January, and listings up 27% if you look at where we were last February. We're talking about 3 prongs here. So the first was property listings. The second, on the environmental due diligence front, daily average activity was up 14% in February above January, 11% year over year. And then the brow wrinkler, Manus, was that the third prong, lender-driven appraisals, contracted a bit by 10% month over month. And I looked back and appraisal activity has been coming down just a little bit since a September to November peak. So, and it's still fairly strong, but maybe it's renormalizing after a bounce that we saw from the rate cuts late last year. But I think, overall, despite everything we talk about in the broader market, we're definitely not seeing a slowdown in momentum. We're seeing a more kind of broad-based acceleration with a pretty strong push from properties coming onto the market.
It's an interesting point you brought up, the head scratcher about appraisal requests being below listings and phase ones. Maybe the simplest answer for this is while appraisals for new purchases continue apace, that whatever benefit we got in the second half of last year when the 10-year went from 450 to 410 on the refinancing side, maybe that just is over now, that we need another leg lower in treasuries before we're going to see appraisals pick up. I can't think of any other reason why those two would detach other than refinancing activity slowing down, I have to say. But I do think, as for the number itself, I think this is wonderful. I can't remember the last time we were at 118. It must have been 2022 or 2021. You probably have to go back several years to have this kind of reading. So I love that it's full steam ahead. And we do have some recent history where the CRE market has shrugged off broader market volatility during the April tariff announcements when the equity markets went haywire and we saw, the major indices down 15 and 20%. CRE activity really didn't slow. And we can only hope that that's the case now with both the PE tumult and the Iran war, that CRE continues to remain the steady outlier.
Let's hope so. I feel like last year we used the word unprecedented a lot because at the time the tariff war was about to kick off. We were adjusting to a new administration. And now certainly we are in unprecedented times because of all the factors that we've already talked about on this pod. So, the March index I think will be very telling because this really is a broad brush across commercial real estate. So any hesitancy or tapping of the brakes should show up early in our data.
All right, Diane, let's transition toward Did You Know for the week. What do you have for us?
Sure. So the index is our early indicator of commercial real estate momentum, but we also closely track deal closings thanks to your team, Manus, which is busily combing headlines. So on that end, I have our preliminary February data on deals that closed. In February, there were a total of 1,168 deals closed. And it was interesting. That was almost on the money compared to January's 1,163. And February was a shorter business month by 2 business days. So not quite at the level of December's year-end surge, which was 1,226, but we'll take it. And kudos to your team, Manus.
Thank you, Diane. They make us look very good. I have to say that between the AI tools they've developed and the sweat equity they put in, it's a really terrific data set that we track. Very proud of the team we've assembled.
All right, let's jump into the deals that caught our eye this week. Diane, let's start with lodging.
Sure. Listeners might remember last week we talked about a slew of hotel deals. We hadn't really covered that sector much before then. And one that crossed my desk this week, and I have to thank my longtime Lightbox colleague, Bob Dearborn, for sending it my way. The story is that an investment firm snatched up 2 hotels in the Bay Area. There were 2 properties. One was the Lodge at Tiburon, and the other was the Toll House Hotel in Los Gatos. The purchaser was KSL Capital Partners in Denver, who bought these hotels through foreclosure transactions. And it caught my eye because the Lodge at Tiburon, I don't know if you've ever been there, Manus, but it is a gorgeous property. Our client, AEI Consultants, hosted an event there that I attended years ago. And it was interesting because combined, the price for these 2 hotels was roughly $20 million below what the seller paid for them 7 years ago when the region's hospitality market was peaking. And these aren't distressed roadside motels. They're 4-star boutique hotels. They're in very affluent markets, and they still traded at a meaningful discount. So, I think this is really kind of a classic opportunistic play. Kind of makes me wish I had 50 million lying around because it could look like a pretty smart entry point in a few years.
It's a bit of a head scratcher when you talk about that because we have seen values on higher end hotels either rebound in heavily hit markets like New York or hold their value at high levels over the last couple of years. So this does seem to be a little bit of an outlier.
All right, Diane, let's pivot here over to retail. Any news to share?
I want to start with a story, and kudos to our Lightbox CEO, Eric Frank, for this one. We are going to bring Eric on as a guest over the next month or so everyone can hear from him directly. And happy birthday, Eric. He sent us an article from the Wall Street Journal that used a term that I have to say I haven't heard in years. The reporter, Kate King, headlined a story, and the headline was "A New Generation of Mall Rats Has Arrived." And in the article, she highlights a trend that Greg Katz mentioned when he was our guest just a few weeks ago. And I think it's a trend a lot of people in commercial real estate may be underestimating. And that is that there's a mall comeback, and it's being driven by Gen Z, the ones who don't put their phones down ever. And their kind of resurgence at malls is flipping the narrative that e-commerce killed malls. They actually want to be shopping in physical stores. They don't want to be shopping online. And it's a whole social experience. I shared this story, Manus, with Miriam Brody. She's at Kimley Horn in Northern Virginia. And she told me that she could attest to this because her local mall is filled with teenagers and 20-somethings, and that they even have an entire storefront that's set up as a selfie where people are paid to go in and take photos and then post them in social media. So there you go, Manus. Malls are the place to go now to see and be seen.
It's interesting. I would love somebody to do a deep dive into the social aspect of it I get, But what products, if any, are luring this generation in? For my generation, there were certain things that you had to go to the mall to get, and it made the mall such a destination, right? Vinyl records or later CDs. You had to go to Sam Goody to go there and get the latest release of whoever your favorite band was. You wanted to go to the sporting goods store, right? You wanted to get that new baseball glove or the Mets jersey, whatever that was there. You certainly wanted to go to the food court and eat the bad food that was there. And if you go back far enough, if you're as old as I am, they used to have ticket masters in malls where if a new Rolling Stones tour was going up, you'd line up outside the Sears where there was a ticket master and wait overnight for the doors to open so you could buy your tickets. So those were kind of unique things that malls had at the time. Now with online shopping, you can get any of this without ever leaving your couch. While we're on the retail segment, I'll run through another story or two. One that caught my eye this week. In Queens, the borough in New York, Northwell Health acquired a nearly 350,000 square foot parcel of the Queens Retail Center, paying $235 million for the asset. The seller there, Alexander Reet, the space had been empty, amazingly, for more than 30 years. So Northwell coming in, shocking that they had to pay so much money to acquire a vacant parcel, but they did, $235 million. But as part of a trend that I see in the Northeast, Dianne, I'm not sure if the two of you see this as well, which is a lot of this older, obsolete space being taken over by big medical operators and turning it into what I would call mid-scale to upscale healthcare, a place where you can go in, see a primary care doctor, but at the same location, get your blood work done, see a specialist if you need to, have a small procedure done, things like that. We've seen them in Yonkers, we've seen them in other places, and they seem to be pretty effective uses of the space.
I think so. And I am seeing that a fair amount in my area of Southern Connecticut, this vacant retail space. In this case, I'm astounded it was vacant that long, but it does happen, and these retail spaces being reimagined into some kind of a medical campus or outpatient care hub where demand is very high. And you mentioned that high price tag. They must see incredible potential in terms of this location and the demographics that are there. But certainly, I think healthcare in general continues to be one of the fastest growing occupiers of space. So great to see an abandoned retail space, not abandoned, but a vacant retail space getting reimagined into a growth sector of commercial real estate.
Okay, Manus, let's transition to industrial stories. What do you have for us?
I have two, which I thought were kind of interesting this week. One in Sunningvale, California, Fortinet, which is an operator that creates cyberware protection software. They are buying a 7-property campus of mostly industrial space from Intuitive Surgical, paying $47 million for 77,000 square feet of space. So industrial, one of those market segments that we talk about CRE being steady. I guess industrial you would call the steadiest of the steady, where there's just constant demand for manufacturing centers, warehouse, distribution, logistics. And here's another example where, in this case, Fortinet looking to expand by 75,000 square feet in California. The other one just hit the wire a few minutes ago. I like this one. This comes from The Real Deal. Crane Worldwide Logistics has leased almost 1 million square feet of warehouse space in McCook, Illinois, just an enormous property there, which will be occupied by Amazon. So sometimes we wonder, at what point does this seemingly insatiable demand for space by e-tailers, by people like Amazon and others run out of steam? And yet it's the dog that never stops hunting, that here we go again with another 1 million square foot lease in the Chicago suburbs by Amazon. So we love that this party never ends in industrial, but I suppose someday it will.
Maybe. We can't live without Amazon. But I wanted to add one thing to the Fortinet story that I read that I thought was very interesting, Manus, and that was that latest deal, 47 million for 7 different properties, I think is what I read, but that company has been spending more than 600 million over the past several years building out its Sunnyvale campus. But there was another interesting twist that the company is exploring converting some nearby commercial space into housing. So it's kind of a broader trend in the Valley where employers are trying to help address housing shortages near job centers, especially where they have campus locations.
It's an interesting thing. This is taking me on a quick detour when you talk about Fortinet and cybersecurity. I was talking over the weekend over dinner with a couple of people, and I think one of the biggest untold stories right now about AI, or will be one of the big told stories eventually, is it's only a matter of time before somebody leaks what is really important corporate IP by using public AI. Here at Lightbox, we have created sandboxes, guardrails, processes. So everything we do is locked down in a place where our IP cannot get into the broader ecosystem and inform models from OpenAI or Claude or anything else. And that's the responsible way to do it. And I do think that it won't be too long before we see a headline where somebody at some firm by accident used the public AI, not the sandbox AI within their own firm, and reveals something like the Coke recipe or, you know, the 11 herbs and spices that make up Kentucky Fried Chicken. I think that will be the thing that really shocks people. And I think that when it happens, somebody like Fortinet or people that whose job it is to protect data and protect networks will be big winners here. That people will say, we didn't do enough to protect our own data, and that's got to end.
Yeah, certainly something to watch. And I'm cynical side of me is surprised that it hasn't happened yet, just given the explosive growth in AI.
Okay. Manus, we have one story on the distressed market. Let's talk about that.
Yes, this is one disappointing story, but I suppose it's not the last we'll see, and it's probably been a long time coming. This particular story, syndicator lender Ready Capital taking a $232 million loss. They will be undergoing a sizable restructuring, and they will be seeking to sell $1.5 billion worth of loans. And the most troubled asset that they own is the Ritz-Carlton Tower in Portland, which was a $460 million loan. Why do I bring this up? I bring this up because what is a syndicator? A syndicator is somebody that raises money from limited partners, uses that money to buy a property. That property, the expectation is they will operate it for a couple of years. They may refurbish it. They may re-rent it. They may grow market rents for the property. But the expectation is people come in and there'll be an exit within 3, 4, 5 years where people will get their money back and a 20% return or a 25% return. This was very popular in 2021 and 2022. Buyers came in, bought value add multifamily properties, had limited partners lined up behind them. Sadly, they used floating rate debt. When rates went up, all of their profits, their operating income went from positive to negative. It led to a wave of defaults. And this is kind of the fallout. When you see Ready Capital taking this hit, it's because the people that they lent to do these types of repositionings or value adds made bad decisions and could not meet their numbers. And in fact, their numbers went upside down from a positive DSCR to a negative one. And this story's been playing out for many years. It really started in 2023 when rates went up. And at some point, this will have run its course and all these operators will have either taken their losses or recapitalized. In this story, it just goes to show that probably still pain to be reported. And it's a tough one.
Yeah, it is a tough one. It's part of that broader cleanup from the 2021, 2022 lending cycle. And in this case, for some lenders like Ready Capital, the hits are big enough to show up clearly in their earnings. So I agree, it's a tough one, and it's a sign that this is a slow process working its way through the system.
Before we wrap, let's shift gears for our slice of life. Six Flags recently made headlines with a plan to sell 7 of its amusement parks to EPR Properties for nearly $331 million as part of a broader strategy to reinvest in its remaining parks. So it got me thinking, what's your favorite childhood amusement park memory? Dianne, let's start with you.
I have to say, Alyssa, this story took me back. Every summer, my family would go to Riverside Park in Agawam, Mass. That is now Six Flags, and I did check your story. It's not part of this sale, so I guess that means that they're using the money that they get from divesting other parks to reinvest in our old park. But, what I was remembering was my parents did something that I'm pretty sure most parents wouldn't do today. They would basically let me and my brother run loose in the park, and we would run from ride to ride. We would bomb through the haunted house, ride the antique cars, everything we could get to. So I think they either loved us and trusted us to be safe, or they didn't.
Well, I have so many stories. We would always go at the end of the year, our high school, to Six Flags in Jackson, New Jersey. It would be about a 2.5-hour bus ride, and you'd be horsing around with your friends, and you'd get there and you'd run around all day. And there were some fond memories and there were some not so fond memories. The fond ones were just all the bad food you were eating and all the rides and the water ride, the flume and everything else. And then there was always the 2.5-hour wait for that new roller coaster that just opened 6 weeks earlier. That was always the worst, waiting in that hot sun for 2.5 hours, watching a quarter of your day go by, waiting to get on a 90-second ride. So, but much more good than bad in my recollection from those year-end trips to Jackson, New Jersey.
All right, and with that, we'll close. Thank you to our producers at Bruning Media. Please join the Lightbox team every week as they share CRE news and data in context. You can listen on any of your favorite podcast channels and send your comments or questions to podcast@lightboxre.com. Thank you for listening and have a great week.
Let's go.